Today we're going to be talking about the when it comes to options, risk management strategies for dummies, right? Before we even get started, let's just zoom in over here to the disclaimer we have to always say, which is everything we provide here is just for educational and informational purposes only. We're not licensed financial advisors, tax professionals, or investment experts. If you want actual, advice, you always should consult a not trading, but a financial advisor. All right. So I'm just going to give you a second to read that disclaimer before we move on. All right, cool. Okay. So I'm going to start off exactly how I started off last time, which is this is a very serious topic. And if you're not going to take this seriously, you might as well just skip it because I take this very seriously and it's a very frustrating topic because I see the same thing happen over and over again. Risk management is not a safety net. It's the line between surviving and disappearing. In a market where some get lucky while others are unlucky, the only way to get probability, accuracy, and consistent success is by controlling emotions and following risk management plans. If you're not serious about trading, you might as well leave now because it will cause you more harm than good. I've been on Discord for about 9 years. I've been personally trading for 11. My trading partner over here, JP, has been trading for over 20. But in the 9 years I've been on Discord primarily, it's always been the same thing, right? Majority of traders on Discord end up quitting after not even a year. We're talking not just members, we're actually talking about people who post on Discord as well. So, and it all ties down to the fact that they don't have proper risk management. I'm in so many servers now, and when I go across all these chats, because I get numerous pings, I don't see proper risk management in 80% of the servers I'm in, whether it's from the members, whether it's from the people who post the trade ideas. Is just a complete lack of risk management. And it's very important because if we're going into a possible bear market or a recession, you cannot trade that kind of environment with no risk management. What we've been seeing the past week or 2 weeks, that's just the beginning of a possible bear market. We're probably gonna have a rally here for probably a week or two, if not less. And after that, when everything hits, that's when the true bear market will start. And everyone who is not prepared is going to be screwed. So if the main goal is survival, because that's what the main goal of trading is to survive enough where you get enough experience that you'll be able to start building yourself a profitable journey, right? And when it comes to trading. So you have to survive first and then look to profit. So if the main goal is survival, each person's situation is different. You have to develop your own risk management strategy before anything else. Now, whenever you hear risk management, you might hear, oh, I need to have good R to R. That's not the only thing. Even though having good quote-unquote R to R, risk to reward, is important, there's so many things beforehand that you have to concentrate on before you can move on to something such as having good risk to reward. So what you need to do is be raw with yourself and ask yourself questions like the following. Can you afford to take risks? Am I living paycheck to paycheck? You could see these two first questions relate to more financial situation, right? And then, am I a greedy trader? Am I a cautious trader? How does my character correlate to trading? Even though these seem very simple and cheesy questions, one of the biggest human flaws you could see that almost every human faces is the fact that they think simple things they don't need to think about. That's not true. Just because these seem simple to you does not mean you've actually asked yourself these questions. Because when you ask yourself these questions, you're going to get a better idea of what you have to face and what you have to do. So ask these kind of questions to yourself because you can formulate a risk strategy plan before you actually go into assessing what risks you can take, because that's how you start formulating a good risk management plan. All right. Acknowledge the risks of each type of trading. Obviously, since we're talking about options, we're going to be talking about day trading and swing trading. I'm gonna list the risk of both of them, and I want you to see the difference in each because risk management is different for both day trading and swing trading. It's not the same for each. So, for example, in day trading, one of the biggest risks is overtrading. It's just very easy. I mean, you're just sitting in front of your screen. Sometimes, if you don't see setups or if you see setups, you're going to end up taking it over and over again, even though you don't probably need to be trading or you shouldn't be trading. Chop, right? Obviously, whenever you're day trading, you're going to be always faced with chop here and there. Again, these things seem simple, but I need you to stay with me so we could go over the simple stuff so I could tie together the complex parts. The next is exhaustion. This kind of ties in a little bit to over trading, right? If you're going to keep on trading too much, you're going to be exhausted. And the reason why exhaustion is very, very bad for a trader is because exhaustion leads to poor trades. When you start poorly trading, any progress, if there is progress, is going to end up vanishing before you know it. So you have to make sure you don't get into being the type of trader where you're trading so much and you get exhausted. Volatility, expansion, and contraction. When you're day trading, you are going to be exposed more and less of expansion of volatility and the contraction of volatility. What this means is, for a few hours, the market could be very volatile, whether there's, Trump saying tariff or he's talking about some kind of, I don't know, war, or let's say Powell is speaking, volatility is going to be high, right? But let's say when they stop talking, there's a possibility that volatility contracts and becomes less, and then your contracts are going to start eating as some sort of an IV crush. So that's one thing. That's also another risk. Technical, lower risk but lower reward. Day trading, when compared to swing trading, technical wise, has lower risk and lower reward. I'm going to explain that in just a second. More stress. I can tell you, especially from my own experience, day trading is more stressful than swing trading. Because when you're day trading, this actually ties into our next part, but you're facing multiple factors. So I'm going to actually get to that in just a second. It's very easy to exit earlier. You can say the same thing for swing trading as well, but when it comes to day trading, again, you're day trading during the day, right? So you have the ability to exit, trim, whatever it might be. And a lot of times you're going to find yourself, let's say, trimming out early or exiting early when it's not following your plan. And, trimming is not a bad thing. But if you're just trimming or exiting earlier because you're anxious that you're going to lose out on profits, that's not really following your plan, right? Sometimes it might be better to be wrong according to your plan versus wrong according to your anxiety. So again, that's up to you. But to me, exiting earlier before what I intended to do, that's a loss for me. Theta. During day trading, since your trading contracts are going to be usually closer to you, that's going to be weekly expirations, right, or zero DTEs. Unfortunately, theta is going to be a huge factor. Zero DTEs. This is I won't ever advocate for zero DTEs. This is usually the starting point for almost every trader, and they might find success here and there, but I can guarantee you. I'm not going to guarantee you, but I can tell you from my experience, in my 9 years, I've not seen anybody trade zero DTEs consistently for more than 6 to 8 months. After that, the trading environment kind of changes and they get screwed over. And even though they make a decent amount of profit in the time where they're doing great, after that time passes, the amount of losses they get surpass the profit that they had and even the initial capital that they invested. So zero DTEs are very, very dangerous. Exposing yourself to your own stupidity. When you're day trading, you're in control. It's not like swing trading where you take a position and then overnight you can't really close it or anything like that, or you can't open any new positions. When you're day trading, you can. And because of that, as humans, as I said, we're all naturally flawed and we're going to sometimes be stupid. And when we're day trading, we allow ourselves to be stupid when we shouldn't be. And even though we can't always make sure we're perfect, day trading will allow us to be more stupid than compared to swing trading. You're fighting two factors here when you're day trading, yourself and the market. right? The market's obvious, right? But you're fighting yourself because it kind of ties into the point I said over here. So you're fighting two factors here, and I personally think that one of the downfalls to traders is the fact that they're fighting themselves. And this is obviously not intentional, right? You're going to, it's just habits or just little mistakes we make here and there, whether it's over trading, entering, exiting early, or taking a risky trade. You're fighting yourself. And when you're day trading, as I said before, you have more time to make more flaws. Now, moving over to swing trading, a lot of what I said here for day trading will make a lot more sense. Where in day trading, I said one of the biggest risks is over trading. Swing trading is kind of different. Swing trading, you won't usually see yourself over trading, but you will usually see yourself oversizing. That's very, very dangerous for swing trading because you have to realize this: you're trading gaps. So if you oversize and the gap, let's say you take calls and you oversize on calls and it gaps down, you're going to be in a lot of pain even if the contract's down only 20%. If you're finding yourself in a lot of pain with just 20% loss, you need to really think about what kind of trader you really are, because that shouldn't really be the case. A 20% loss, of course, will always hurt, but it should not hurt to the extent where you're like, oh my gosh, there goes my week of progress. That's just wrong. Less control. Obviously, in the after hours, anything can happen, whether it's news, whether it's Jerome Powell saying anything, whether it's Elon Musk jumping up and doing the Nazi salute, whether it's, Trump saying tariff, right, or something like that. Things are out of our control. So, we can't really control what happens even if we get into a great setup. Next thing is higher chance of news and data. These kind of tie into together, so I'm going to skip that. Technical higher risk, but higher reward. In day trading, the reason why people overtrade is because they end up getting less reward than what they expect. When it comes to swing trading, it's quite the opposite. You either usually make a lot or you lose a lot. So if you look at everything, you cross the T's and you get into a great setup, you are risking. You are getting into a risky trade because swing trades are riskier than day trades, but it's only risky because of factors you cannot control, right? Versus day trading is riskier because of factors you can control, but because we're humans, we're naturally flawed to not be able to control them correctly. So here, the higher risk is because of the uncontrollable effects, but if those uncontrollable effects don't affect your trade as much, the reward is much higher. Stop losses are harder to manage. Obviously, in day trading, you can do that, but in swing trading, in my personal experience, has not been the greatest thing because sometimes if you get into a trade, let's say near the end of day, the next day the market opens, the first minute or so, like the contract just goes here and there, right? There's orders from the previous day filling, and because of that, stop losses on swing trades can sometimes get you wicked out of the trade. And even though the trade starts going your way, some random order could just wick you out. And that's one huge risk to swing trading. That's why you can't use stop losses. Well, let me rephrase that. That's why I personally don't use stop losses on swing trades. When I said about day trading, I said that you're fighting against, the market and yourself. Here, to swing trades, majority of the times, one of the biggest risks is exposing yourself to weaker hands. This happens when, let's say, a swing starts going your way, but even though you see the bigger play, you end up exiting for like 20%. This happens a lot of times, and you have to realize swings are meant to be, usually, if you plan them right, bigger trades. So if you're trying to get into a bigger trade, one of the risks is if you don't plan it out properly, you're going to be exiting the trade before you should. All right. And the last thing is you're fighting news, data, and the market. So two of these are obviously uncontrollable. You can try to prepare for it. Obviously, if you know economic data is coming the next day, the positions you swing into tomorrow can maybe not be, not like news and data oriented. But sometimes even you still will be impacted by news, right? So that's why it's very important that you realize that when you're swing trading, the biggest risk is the fact that you're going to be fighting against news and data. And of course, the market, that's always going to be a factor no matter what. So you can see here between these two, each have different risks. So you need to be able to come up with good plans for each, because day trading is actually very different than swing trading. So you need to figure out like, okay, for day trading, do I want to do something different than versus swing trading? So again, I'm detailing this now because we're going to dive deeper into the different types of way you can have a management strategy plan for each kind of trading style. So for day trading, it is crucial to try to implement the following: setting yourself a dollar limit or a percentage limit. This is very different than the idiotic thing I always usually hear is a money or a numerical goal or a percentage goal. A goal is different than a limit. A goal is, let's say, if you say, hey, I'm going to try to get $200 per day trading, that means you're trying to look each and every single day to reach that goal. For some people that might work, but majority of people does not work, because on the days where we're below that whatever goal we set, let's just say $200, let's say that day we only make 125, even though 125 could be a good day, we still will have in our head like, oh man, I didn't make my goal, let me try to get into another trade. And sometimes, yes, we might get into a good other trade, but a lot of times we end up risking or forcing trades that we might not even think are forced trades, but in reality they are. So a limit is where, let's say, for example, you have a $200 limit each day. Even if you make 125, that's okay, that's fine, it's below your limit. But let's say you take like 2 trades and those 2 trades surpass you past your limit, which is $200. Let's say you make 275, that's it. You're just taking yourself away from the screens, you hit your limit. You're not going to take away all the profits that you see and just give it back. One of the silliest things is allowing yourself to be to be convinced or influenced by yourself or others when they tell you, oh, it's I made my goal or I made my limit, but I see a great setup, so might as well take it, right? Just because there's a good setup does not mean you have to take it. That's the silliest thing you can ever think. You don't have to. You just don't have to. All right. So, and also another thing is, instead of a money goal, you could do a percentage goal, which I personally prefer, because percentage deals with portfolio percentage, right? So let's say if you're up 1% or down 1%, that's, I think, is a better, in my opinion, a better number to look at, because that relates to growth, versus money is going to be a lot more influential with your emotions when it comes to trading. So you might want to potentially set yourself a money limit for both green days, money or percentage limit for both green days and red days. So again, everything what I'm saying here still ties to what I said here earlier about these questions you want to ask yourself. If, let's say, for example, if you cannot afford to take risks and you are living almost close to paycheck, when it comes to this part over here, to setting yourself these limits, maybe you want to have a lower limit where you just, look to slowly grow your account, day in and day out. And, even if you get some red days, it's okay. You're at least limiting yourself. So these are things you have to think about. Have an ego against the market. When I say this is not saying like, oh, be stubborn and stick in your position that's already down. No, I'm not talking about that. What I'm talking about is making sure you have an ego in such a way, even though this sounds cheesy, where you're thinking to yourself, okay, I'm not going to let, the stock market get the better of me. Meaning, let's say you're up or down, you're not going to just feed in to whatever's already a good day or whatever's already a bad day. If you're already up for the day and you don't see anything else, just walk away. There's nothing you have to do. When you're already down for the day, let's say you hit your percentage limit, let's say it's 1% or 2% of your portfolio, why would you just stick around to try to make that loss back? It makes no sense. And I do not see people who are consistently profitable past a year thinking with that kind of mentality, right? If they're thinking, oh, let me make my loss back or let me keep on trading more, they just don't last. And if they do last, it's because they're idiotic enough to, let's say, have, whatever it is, they just keep on pouring more money into their account. They just are okay with risking it. That's up to them. But for majority of people, you need to make sure you have an ego in such a way where you're thinking, okay, I'm not going to let the market get the better of me. I'm not going to let my own emotions get the better of me. And I'm not going to let my own laziness get the better of me. Treat trading like a job. This is not a game. You guys realize I've been trading for 11 years because I'm one of the most monotone people you can meet, but also because I take this very seriously. I mean, this is why live sessions exist. I'm very passionate and I take trading very seriously. And when I see people, and I'm sorry to say this, when I see people who take this as anything else but an actual serious topic when it comes to trading, just trading in general, they don't take it seriously, I lose respect in them, for them, because what makes you think you cannot take this seriously? I'm telling you, I've been here longer than you, and I've seen people who've not taken seriously, and almost all of them, I'm telling literally all of them, from members to traders who post on Discord, are all gone. The people that were here before the pandemic, gone. People who were here during the pandemic, gone. People who were here even after the pandemic, some of them are gone. So please, treat this like it's something serious. Do not treat this as a joke, or you will become the joke. Avoid chasing adrenaline rushes. This kind of ties into riskier and out of the money contracts or zero DTEs. Yes, of course, it's great. It's great when we hit those trades here and there that are pretty huge. Just either if we take farther out of the money contracts or zero DTEs. But realize this, you're not always going to be lucky. Yes, lucky to be able to recreate that kind of success over and over again on a constant basis. Again, the key phrase and the topic we're locking in here is the word constant and consistent. Because if you're not trying to be consistent, I'm telling you, majority of the times people who start trading are actually going to end up losing money and putting themselves in a deeper hole than they were in the beginning. Avoid relying on zero DTEs. This kind of ties into the thing over here. You're not going to do well just trading zero DTEs. That's just a fact. Take Friday, for example. Take Thursday, for example. Those were low volatile days, especially Friday. I'm pretty sure it was Friday. One of those days, maybe it was Thursday. One of those days had really high IV on the option chain of QQQ. A lot of people got burned that day. Even if they got the sentiment right, they got very burned on Thursday. And on Friday, people got burned because the market was just very volatile. So avoid relying on zero DTEs. You have no safety in zero DTEs. You can be either insanely right or insanely wrong. And if you can risk that, go ahead. That's all you. But majority of people can't. Utilizing stops or mental stop losses. Obviously, when it comes to day trading, you have to make sure you utilize stop losses. That's what I would say is, in my opinion, better for majority of retail traders, using just hard stop losses. Mental stop losses you really wouldn't want to use unless you've been experienced or trading for a while, because then you could kind of make sure that you're actually sticking to your plan. And if you're in mental stop losses, sometimes you just end up thinking, even though it hit here, maybe if it just kind of bounces up, and that whole kind of thought process leads down a whole spiral that you really don't want to be risking. So obviously, when you're in any day trade, you should have a stop loss or you should have a mental stop. And when I say this, I'm talking about the people who just think, I'm fine if it goes to zero. Some trades, okay, I understand that, but you should not be thinking that for a majority of your trades. Focusing on bigger time frames. Yes, this applies to day trades, right? If you want to have your trade having a bigger or better probability, one of the easiest things you could do is try to figure out what the sentiment or what the situation looks like on the bigger time frames, because that leads you to be able to hold trades longer, because obviously the trade runs more in your favor. So focusing on bigger time frames is very important when it comes to day trading. Sorry, I was taking a drink of water. Avoiding average downs. Averaging down, in my experience, is better, in my experience, emphasis on that, for swing trades. Because on day trades, since it's low risk, low reward, you're usually already sizing pretty decently. So if you're just averaging down on a trade that's a day trade especially, you're doubling down most of the times on a trade that's not working out right. You don't want to do that, because a lot of times when your setup gets invalidated, you pretty much know right away when it comes to day trades, right? So avoiding averaging downs in day trades is typically better. And instead of trying to figure out how you can average down, it usually is better to figure out how you can be better with your entries, because it is much better, in my experience, to just perfect your entries and avoid the averaging down part to make sure you actually do pretty well. So now that we went over day trading, we're going to go over swing trading, and there's still a lot more topics we're going to discuss. You guys can again ask your questions, and I'll get to them after all of this, after this presentation is done. So swing trading risk management is very different than day trading. It's very crucial to implement the following. Limit your sizing. This ties into the first point I talked about when we're talking about the risks of both swing trading and day trading. This swing trading is already a high risk, high reward strategy. That means even if you size moderately or small, your reward, if it goes right, typically is pretty big. So what is the point of oversizing? Because if you oversize and you don't limit your sizing, a lot of times you're just going to find yourself in a bigger loss than you really want to be. So make sure that one of the first things you want to do is limit your sizing so you can just try to grow your account, because again, surviving and growing your account is one of the most important things. As I said, these are meant to be bigger trades, so you don't technically need a big sizing. Know what will invalidate your swing. Don't just take a swing and then the next day just, based on if it's down or up, that's when you figure out if you're going to exit, trim, or exit for a loss. Make sure you figure out, after the day closes and you're in these swings, go on the chart, look at the chart, find the crucial levels that, let's say if you're in calls, that your stock needs to be above or open above, right? And then if it opens below those levels, you need to know, like, okay, all right, if it opens below 200, let's say, for example, these calls are going to be invalidated, right? Or if it opens below 200, but then the 30-minute closes above 200, my calls are still fine. So you need to figure out what you need to know what the invalidation points are. And I'm going to tell you up front, it's not hard to do that. It's very easy. Just look at the historical price action. Just look at the levels that are the important levels, and you could kind of figure out, okay, if it opens up here or if it closes below this, then this will be invalidated. It's very easy to figure out these plans. You just need to put the time into it. Learn to recognize fake outs. This kind of ties in with looking at bigger time frames when the market opens. If you're in a swing, for example, let's say you're in a swing with me. Take for example the Coca-Cola swing. We swung from Thursday to Friday. Coca-Cola opened up red, right? It gapped down. We took calls. It gapped down, but after that, a few minutes afterwards, it started squeezing to the upside. So you need to recognize when a fake out is there and when it's actually a real breakdown. There's many ways you could do this. One easy way, without getting into too many details, is just looking at a bigger time frame and waiting for that time frame to close. And let's say you're waiting for a 30-minute time frame to close. Yes, you are going to be, looking at waiting for 30 minutes past market open for you to figure out if your trade's invalidated or not. But think to yourself this question: if you're limiting your sizing, if you're limiting your sizing, you could theoretically risk waiting for the candle to close to figure out, okay, is this actually a breakdown from what I want, or if this is just a fake out and I could still stay in this trade. Knowing when to average down. As I said, when it comes to day trading, averaging down is really not something you want to be in, because again, that's just not what day trading is meant for. And when you're already in a stressful environment, when you're day trading, averaging down is not the greatest thing. When it comes to swing trading, if you're swing trading, you're looking at the bigger time frames already, right? So that means you're trading the larger sentiment, and sometimes even though the larger sentiment is going to work out, the next day, if you take, for example, calls, a stock might gap down, but eventually you might, come back up, right? If it's still, not invalidated yet. So you want to figure out if emphasis on if you want to average down and when you want to average down. Just because the swing is down does not mean you average down. That's just not the case. But if there's valid points of averaging down and you have a concrete plan, then, if you're limiting your sizing, and then potentially following a plan to average down, it might not be a bad idea. Now, stop losses and position sizing. Both sizing and stop losses correlate pretty well with each other. For example, and I need you to pay attention for this, because this is a big misconception and I need you guys to understand this. If you're day trading and buy an expensive contract, like let's say $4, You're not risking $400 unless you're completely dumb. You're not just letting it go to zero. If you're letting it go to zero, you just need to go sit in a sauna and just figure out what you're doing with your life. If you have the money to risk that and go sit in a sauna and actually think about that, then maybe it's not an issue to you. But again, $400 is a lot of money, and to everybody, it's a lot of money. Any kind of amount of money is money. So just because a contract is valued, let's say 200, 400, 600, 100, whatever it is, you're not risking all of that, especially when you're day trading. You're only risking what you're planning to risk. So what I mean by that is, as I continue over here, you risk whatever you want from that $400, whether that's $40, whether it's $40, $80, or $120. What I mean is let's say you get into a day trade and the contract cost is $400. You're not risking that $400 if you're in a day trade. You have a stop loss. You're able to control that trade's outcome in terms of how much you're losing versus how much you're gaining. So just because you're in a $400 contract doesn't mean you're risking $400. If you could just might as well, out of the $400, risk maybe $80, so your stop loss will be at $320. So realize this, because I want you to realize how important this point is, because the biggest misconception is, oh my goodness, this contract is so expensive, I can't buy it because I can't risk that much. That is completely untrue. You can think of it in this way. If you have a proper plan, because of course, if you're just getting into an expensive contract and you have no plan, then you might as well just take your money and give it to charity, right? So if you have a plan, if you have a stop loss, you can get into these more expensive contracts, hypothetically, and just only risk what you're willing to risk. The reason why this is better sometimes is kind of ties into a point I'm going to talk about a little bit later, is that usually expensive contracts are obviously the ones that are either in the money or at the money. And in the money or at the money contracts are way safer than out of the money contracts. But we'll get into that in just a second. Again, even though I just talked about this, that does not mean you full port. Nothing I'm talking about says you're full port. Full porting will never be the smart thing to do. Because the main reason is because no matter what, whether you're day trading or swing trading, there's still going to be unpredictable factors and unpredictable movements that will just cause you to have bigger losses. So instead of trying to just rely solely on your stop loss, you want to also limit yourself in how much you size. So keep that in mind. Nothing I'm talking about advocates for full porting. Hard stops and mental stops. Which one you use is up to you. Usually hard stops are better for people who are not consistently profitable right now. So if your account is usually, let's say you go to whatever platform you're using and you look at the past month or past 3 months, if your account is down, hard stops are probably going to be better for you, right? Let's say you have a good plan. It's just, some things you got to fix here and there. Maybe you could quote unquote upgrade to a mental stop, because mental stops is again another higher risk, high reward thing where you can allow your trade to work out. And, instead of getting stopped out, you can actually avoid being faked out and then your trade run. But that is much riskier, and this is not usually for retail traders. So not retail traders, beginner traders who are not even profitable. So make sure you figure out which one you want to do. Again, that's up to you, and that ties into the first questions I talked about in the beginning of this live session. So here's the interesting part that I want you to consider. Everyone knows obviously the percentage, like 30% of your contract or 20% of your contract. You can also potentially set your stop losses to a percentage of your portfolio you're willing to risk / lose, or an option contract. For example, 2% of your portfolio or 30% of the option. So what I mean by that is, let's say you get into a contract, let's say it's an expensive contract especially, you can obviously, if you have your own plan, you want to be like, okay, I don't want to lose more than 20% or 30% of your contract, that's fine. That's fine. Another way you can also think about it is, okay, I'm getting into this trade that, let's say the $400 contract, I'm only going to risk 1% of my portfolio on this trade. So let's say your account is, let's say $5,000, right? $5,000, 1% of $5,000 is $50. So instead of putting let's say 20% stop loss on that $4 contract, you're instead putting a $50 stop loss. So you get stopped out at $3.50. And if that actually meets your percentage limit loss, that's it. You just stop for the day, you come back another day. Here's why I think, me personally, why this way is better for some people. Because this forces you to think and rethink about the trades you're getting into. If you set it to a percentage loss in terms of your portfolio, you're going to be forced to think, okay, am I taking a dumb trade here? Because if you're taking a dumb trade and that ends up hitting your percent limit, you're just going to be thinking to yourself, okay, like, I just lost like 2% of my portfolio. I already got stopped out. So, I'm just no longer trading for the day. So a lot of people are not going to want to be in that position where they just, are not able to trade, or just that's it, right? So setting yourself this portfolio percentage sometimes as your stop loss can work to your advantage, because it forces you to think, hey, is this a good trade that I'm taking? Nobody talks about this. I wish more people did. This is something you could possibly do, and this way you could kind of get into more quality trades, because again, that's what you want to do in the future. You don't want to just be sticking, here and there, doing small little trades over here, trying to grab shekels. Sizing. Usually you hear the usual typical rule, sub 30% of your portfolio in each trade is usually good, around 20% is pretty safe. That's your usual guideline. This again is really up to you, but one thing you have to realize is account size really matters. Account sizes and position sizing have an inverse correlation. What I mean by this is, let's say you start with a $1,000 account and you're willing to put 30% of your account into each trade. If you grew that all the way to, let's say, $5,000, you don't want to be risking 30% of your portfolio when you have that much growth. You're just risking all that hard work. What you could do then instead is, since already you're working with a larger capital than what you did when it was $1,000, instead of risking 30%, maybe you could only risk 20% or less than that. Because even though it's a smaller percentage, the number or the capital you're working for is still bigger than what you worked with 1,000. So 30% of 1,000 is what? That's $30, right? And 20% of $5,000 is... Wait, I'm dumb. Hold on. No, 30% of $1,000 is $300, and 20% of $5,000 is $1,000. No. Anyway, you guys get what I'm trying to say. I can't think right now. I'm Indian, I promise. But you could see how, even though it's a smaller percentage, the risk that you're having when it comes to your portfolio is a lot smaller. So then you're preserving the growth that you had till that point. So you have to realize, the bigger your account gets, it is usually not smarter to increase your percentage portfolio that you're putting into each trade. You would want to typically look at a smaller amount, because you're still growing your account at a pretty moderate rate, or if not fast rate. Next point, adapting to market changes. Here's one thing that people don't talk about, the VIX. The VIX is an easy tool you can use that you can actually look to figure out what kind of risk you're willing to put on. As I wrote over here, using the VIX can help you figure out what amount of risk you want to put on. We have a video on the VIX that JP perfectly narrated. That's on our YouTube channel, which you could check out. But let's say, for example, if you see the VIX above $25, which means that the market is in a very volatile state, you might want to have a tighter stop loss because of the volatility. Because when you're in a very volatile environment, if your trade gets invalidated, it gets invalidated very quickly, and there's less chance that trade's going to end up, coming out green, later on in the day, right? With volatility, a lot of setups get invalidated. So if you see that the market's in a very volatile state, and I said in this example, if you see the VIX above 25, maybe you might want to consider a tighter stop loss, right? Versus if the VIX is lower, at a lower level, then you could possibly have a little bit of a looser stop loss, because you will allow your trade to develop, because there's a higher probability of workout compared to in a volatile market. Knowing when to sit out. I cannot stress how important this skill is that barely anybody has. Some people do, and I won't take it away from those who do, but knowing when to sit out is very crucial. You shouldn't be trading every single day. There's no point in playing Where's Waldo with money. It's just the dumbest thing you could possibly do. Instead, try to figure out that, trading like there's no tomorrow makes absolutely no sense whatsoever. If the world was ending tomorrow, what's the absolute point of trading for a few shekels? If there was gonna be, if you, like, for example, looked on the news and you see, oh, humanity is dying, there's a plague and it's gonna infect everybody, even in bunkers. What's the point of trading like it's crazy, right? So like the world's gonna end. That money that you make is not going to end up being there tomorrow. So just, even though that's a dumb example, what I'm trying to say is the world's not ending tomorrow, and if it was, it doesn't matter what you do today. So realize that the market's there every single day, and realize I'm here after 11 years telling you that I've been trading with the thought process that, hey, I can still trade the day after. I have no rush in trading this day. I'm not missing out on anything because there's always opportunities. And even though it might be slow to approach us, there's still opportunities out there. You don't need to rush in anything. Know when to sit out. Please, I mean this from the bottom of my heart. This is probably the most important message you could get from today. A lot of you don't sit out. Know when to sit out. IV, which stands for implied volatility. If an option chain has a higher than normal IV, it is best to not trade it at all or have tight stop losses. Again, IV ties into volatility. This kind of ties into what happened on, I believe, Thursday, where QQQ had an insane high IV on its option chain. A lot of people lost a lot of money because if the stock did not go in the way that they wanted, the contract lost a significant amount of value. So instead of just trading in a very high volatile or high IV option chain such as Tesla, look at another stock. Maybe look at Microsoft. Why do you think I've been day trading Microsoft? Do you think I'm day trading Microsoft because I want to be a grandpa? No, I'm day trading Microsoft because it provides a better trading environment and better probability than Tesla. I still have the balls to trade Tesla. I still do it on the side whenever I want. I just don't post it. Because if you guys went back to our current IV, not current IV, if you went back to our IV video, one of the most important things that you need to learn is current IV percentile. And if you don't know what that means, go watch that video. It's very important. But Tesla's current IV percentile almost all of last week was either 98 or 100%. That means, to put in very simple terms what current IV percentile means, in the past 52 weeks, the IV that was on the option chain for Tesla was the highest it's been in the past 52 weeks. That is insanely high. If your current IV percentile is past 50, that's already high. If it's 60, that's pretty high. Imagine 100. That's what Tesla was on Thursday, Wednesday, and Friday. So a lot of people have been trading Tesla in a lot of servers, and I get that. It's very exhilarating to trade it. But a lot of you guys lose money because, one, you don't even know how to trade and you don't know how to plot levels and stuff like that. But two, because even if you get into a good trade and it just takes time for it to work out, if the IV is so high, your contract is going to be affected by IV crush. IV crushes do not just impact earning trades. IV crushes impact any trade that has high IV on the contract. So realize that if you're seeing an option chain with high IV, and you could tell if it has high IV by looking at the current IV percentile, if it has high IV, might as well be better to just avoid it and wait for that IV to come down, because everything always reverts back to the mean or back to the average. Tesla used to be at 50% current IV, I think 2 weeks ago. So even your favorite stock, even if it's high, it's okay, bro. Like just wait. Just wait a week or two. There's 1,000 other stocks you can trade. Come back to it when it's safer to trade, especially if you're not consistently profitable already. Now, next point is trade management. Limit versus market orders. This is very important for the people who follow my swing trades, especially, or take similar swing trades as me. Limit orders are usually always better than market orders. That is just a fact. Market orders should always be backup orders, like a plan B, only in tight spread options, basically spreads that have a bid and ask of less than 3 cents, right? So for example, a tight bid and ask spread stocks or ETFs are like QQQ and SPY. They have tight spreads. They're usually just 1 cent or 2% apart. Nvidia has usually a tight spread as well. It's usually just 1 cent or 2 cents. But a high bid and ask spread stock would be something like Netflix and Meta. Tesla has now also become a little bit on the bigger, wider bid and ask spread. So when you're in that wider bid and ask spread, limit orders are always going to be your friend. Recently, I think on Thursday, I forgot which trade I took. I feel like 167. I posted that. I got into that swing 10 seconds after I got into that swing. The price of that contract could have been easily filled at $1.70. Some nutcase, and I'm sorry if you're on here, some nutcase market ordered it and got filled at $1.95 when the contract price was at $1.70. So again, market orders are not usually your friend. The only time you would want to really revert to that is if you're trading something that's very volatile, such as QQ and SPY if you're like really up. So for example, I'm just going to tell you what I usually do. If I'm in an SPX trade, or I don't really trade QQ and SPY anymore because it's boring to trade those for me. But if I'm in an SPX trade and I'm like up like 80%, then I don't mind doing a market order because one, I already know the SPX option chain has a decent amount of volume, and two, I'm already up so much. So even if I had to sacrifice like 5 or 10%, it's okay. But it's much different when you're entering into a position or trimming a position that's not really up significantly, because you're just exposing yourself to either getting a bad fill, which happens majority of the times when you do market orders, or you're going to expose yourself to having a bad entry. And if you have a bad entry, that's not good, right? Because you're going to be exposing yourself for, even if your trade is working, everything's going according to plan, but because you, like a dummy, you went for a market order, you're going to find yourself that the trade is working, but it's, even though it hit your target, you're actually not up that much. And then you're just sitting there like, oh, dang, I should have waited and limit ordered it and just gone with that. Give me a second while I take a sip of water. Sorry, I'm fasting since it's Ramadan. Weekly versus next expiration contracts. Oh my gosh, contracts. Weeklies are usually good to Wednesday. What I mean by this is, JP, 1 second. What I mean by this is usually, let's say you're trading any ticker, you're trading a weekly contract, day trade. Monday, Tuesday, Wednesday, data still affects those contracts, but since it's still 3 days away from expiration, it's not as a significant factor compared to after Wednesday. So Thursday and Friday, obviously, as you know, IV and theta is going to be a huge factor. So maybe up till Wednesday, maybe it's okay, you could trade for the same week expirations, but next week, but when it comes Thursday, why not trade the next expiration, which is usually the week after, right? Depending on the ticker, you would want to switch to next week cons for safety after Wednesday. So what I mean by this is Tesla, for example, everybody loves trading Tesla. After Thursday, because the Tesla contracts are very, very expensive, they are going to have a bigger theta factor on them. And since they're already volatile, they're going to have a bigger IV factor on them as well. So maybe when it comes Thursday, what you could try doing is maybe instead of buying the same week contracts, you can buy the next week contracts. And the great thing is when you do that, you can at least let your trade try to work out and work in your favor instead of just being stressed out about, small movements which decrease the value of your contract by 10 to 20%. So you want to consider possibly going to the next expiration for safety. Monday to Wednesday usually is pretty good. I like trading those. But when I'm trading a Tesla such as Meta or or Tesla, since those contracts are already pretty risky itself, I would want to possibly consider the next week contracts, again, if I am a trader who's not already consistently profitable. In the money versus at the money versus out of the money contracts. This is a very important thing I want you guys to figure out. So in the money is always going to be, actually, I'm going to just scroll down here and it kind of explains it right over here. So very simply, if you want safety, you could choose in the money contracts. If you want safety and risk, you could choose at the money contracts. If you want pure risk and no safety, you choose out of the money contracts. In the money and at the money cons gain and lose more money, while out of the money cons gain or lose more percentage. What I mean by this is in the money and at the money contracts are going to always have a higher delta. Not going to get into a deep dive here on what delta is because we'll have a video on that. But delta is just the amount or value that the contract will change for every single dollar the stock goes up or down. So if the in the money and at the money contracts have higher delta, that means the money, like let's say if you get into a $4 contract, you might be up $40 on that contract, right? Because the delta is higher, but you're only up 10%. Versus in the out of the money contract, you might spend like $40 instead of $400. But since the delta is lower, any increase in the contract will make the percentage actually higher than the amount of money profit you get, for lack of better words. So usually if you're already struggling day trading, it might be better to consider trading at the money contracts. In the money contracts, I personally don't really trade it unless I'm buying leaps. So, I mean, I completely understand if you don't want to look at this, even though if you want safety, in the money contracts are perfectly great. Me personally, I like getting a mix of safety and risk. So at the money contracts are actually sometimes a better thing to look at. Because as we talked about stop losses earlier, you're not risking, if you get into an expensive contract, you're not risking all of that money, especially in a day trade. You're only risking what you're willing to lose. And at the money contracts are going to hold value better than out of the money contracts. And it's a simple factor that the at the money contracts, and I know this sounds complicated, but I'm going to keep it as very simple, and I need you to keep it simple. At the money contracts have a higher delta. So what that means is out of the money contracts have very small delta. So if those contracts go from being out of the money to even farther out of the money, it's going to take a lot of work for those out of the money contracts to come back to the same place where it was before. Versus at the money contracts, even if the trade goes against you, since it's close to being in the money, the delta is very high. So eventually if the trade were to go your way, the contract gains value pretty quickly and it goes back to what it was before. So consider possibly using at the money contracts versus out of the money contracts. And you could see that could potentially cause you to have better trades and a better growth in your account. Again, I say this over and over again. Just because something is expensive does not mean you should go for something else. Just because something is cheap does not mean you go for it. Things are cheap for a reason. Things are cheap if they're either bad quality or they have high risk. Again, if you're fine doing high risk, if you have the money to burn, that's you. That's on you. If it works for you, great for you. I'm happy. I genuinely am. But again, majority of people can't risk that. So don't just go for something because it's cheaper. Go for something with value because you're giving yourself safety while also giving yourself risk. Because when you get into any trade, it's already risk there. So pitfalls you would want to avoid. Managing too many trades at once. This kind of relates more to day trading than swing trading. Obviously, it's always best to not be into too many positions because when you are in too many positions, you cannot give more attention to each individual one. When you're in a day trade, if you're in 2 day trades versus 4 day trades, that's a big difference because in 4 day trades, you might find yourself, I don't know, but this could be the case, you can find yourself possibly anxious, right? Because, you're looking at multiple trades and it's going to be hard to execute each one to the desired area or satisfaction, right? So you want to make sure you follow your plan, and the best way to do that is making sure you're looking at a few trades at each time. Again, when it comes to swing trading, it's kind of hard to get into too many swings, but maybe a number that would quantify as too many swings is more than 4. 4 itself is also already like too many swings, to be honest. Yeah. Here's an important one, and I'm saying this as a person who posts on Discord. Over-reliance on Discord traders and trading indicators and algos. This here is the two reason of why members, unfortunately, that I knew from a year ago or 2 years ago are no longer here on Discord. You guys just rely too much on Discord traders. Yes, of course. I'm saying that as a person who profits off of you relying off of my trade ideas, because then I get hired into other servers. I get that. But I'm telling you now, as a person who's looking out for your well-being, you shouldn't be just relying on Discord traders posting their trades. If you want to get an idea of what they're trading, if you want to possibly follow along based on your risk, that's fine. I'm not saying that's wrong. What I'm saying is wrong is you're just waiting for them to post for you to figure out what to do. Why are you doing that? If you got your own two set of eyes, you got your own two set of hands, and you got your own brain. You can come up with trading plans. You don't need, for example, for me to post what I'm doing about my swing trade before the market opens. You should already know. You had a whole day from the day before to the day now to figure out what am I going to do with this chart, right? My risk management, my risk tolerance is much different than yours. I can risk losing money. Some people can't. So you don't want to over rely on traders because for example, what if I trim at 30%? And by the time I post that I trimmed at 30%, the option goes from being up 30% to being down 20. It's a huge difference. So you need to come up with these plans yourself, and you need to think to yourself, okay, what do I do here? I've said this many times before, and unfortunately Discord's people don't use it this way, but the only main reason why you would want to look at Discord traders is to figure out why they're entering trades and to figure out what they're looking at, because that could give you a better idea. Just give me 1 second. I'm getting a quick call. Sorry about that. That was my father. So as I was saying, you don't want to over rely on Discord traders. This applies as well to indicators and algos especially. You don't want to just rely on what they're showing, because if we remember in the bearish market video, I talked about how certain indicators such as MACD and RSI will start losing a lot of value, especially when it comes to the second leg of the bear market, which is what kills everybody. And the reason why it kills everybody is because there's usually two legs to a bear market. The way a bear market goes is something like this. There's a steep curve, a bull rally, and then there's a huge drop afterwards. This is considered a bull trap. This is where people lose most of their money. We're probably over here right now. And the way the market was looking on Friday, we're probably going to get this rally right now. So when it comes to this point, a lot of people lose money in this point. And it's because this is when the indicators start losing value. This is when the MACD starts losing value. This is when the RSI starts losing value. Indicators that don't lose value, as we said in that video, are stuff like moving averages, VWAP, and so on and so forth. You could watch that video because I'm not going to get into in detail. But you don't want to be so reliant on trading indicators and algos because they can sometimes give you false signals. So tying again what I talked about on this subject, no one knows what you can or cannot risk but you, so you need to come up with the plans yourself and not wait for people like me to post what we're doing with our trades. Over relying on indicators can cause you to break your own rules because it gives you false signals. I know people who trade, for example, the MACD or the RSI, and let's say they're in calls and the trade's going against them. The indicator like the MACD or the RSI will still tell them, hey, it's still going to eventually reverse into the upside. Just stay in. Again, if you can risk that, absolutely fine. Most people can't. And you have to be realistic with yourself. Can you actually risk that money? And it's not just a simple answer of, oh yeah, I can risk it. No, you got to ask yourself, okay, is it going to hurt if I lose that money? And if the answer is yes, why are you just solely following on that? So follow your own rules, follow your own plan, because when you do that, you will find yourself not relying too much on these indicators to stay in your trade. You'll follow what's going on in front of your eyes and the plan that you had beforehand. Picking the wrong platform can lead to a huge downfall for many traders. As you guys know, Obviously, I've always shitted on Robinhood, but every platform has its own unique, abilities or pros to it. One thing I will advocate Robinhood is possibly good for is long-term portfolios, dividend portfolios, or trading trading leaps or complicated option strategies. Robinhood for that is fine because it has lower fees and a simple UI. So okay, that's fine. But majority of you guys here are not here for buying leaps. So, or building dividend portfolios. Majority are here because you're possibly day trading or swing trading. So then look for the platforms that are meant for day trading and swing trading. Many of you guys use Webull. I don't have too much wrong to say about it, but I'll phrase it like this. In a world of trading platforms, Robinhood is the worst. Webull is just one step above it, but many steps behind the superior trading platforms, such as Interactive Broker, Fidelity, Thinkorswim, which is the best trading platform, and E-Trade, which is the second best trading platform. So I'm pretty sure there's a lot more that I'm not talking about, like tasty trades. So figure out what you're trying to trade because each platform is built for a certain type of trader. For example, Fidelity is great for swings and long term, versus E-Trade is built more for older or sophisticated traders who like looking at data and news. Thinkorswim is basically the jack of all trades, which is, I'm not saying this bias, it's just a fact, is the most superior trading platform because it allows you to have so many tools that no other platform allows you to have, while also giving you the best fill times out of every single platform. What's the downside to these superior platforms? They all have commission. But again, just because you get charged a higher price tag at something does not mean it's bad. So do your own research, figure out what trading platform is good for you. You have the things such as, Grok, Gemini, ChatGPT, whatever you use to figure out, okay, this is the way I trade, this is the way I do things. What trading platform is good for me? You can figure that out by yourself. Not setting time limits is a huge mistake that people do. Putting yourself to trade in longer durations usually leads to exhaustion and poor quality trades. Just because there is how many, 9:30, that's 12:34, that's 7 hours in a market. 7 hours and 30 minutes does not mean, right? 7 hours and 30 minutes in a market does not mean you have to stay the entire 7 hours and 30 minutes. Out of those 7 hours, the market's not going to be filled with volume the entire time. Usually the volume, I'm in Eastern time zone, so usually volume's from 9:30 to 11, sizzles out from 11 to 12, and then 12 to 1 it's usually dead, and then the volume starts picking up again at 1 and 1:30 all the way to 2:30, and then obviously then what's it called? Power hour comes where the volume picks up again. So you want to figure out which is the best time frame for you to trade, because that way you're not just letting yourself deal with exhaustion when it comes to trading. So you don't need to trade the whole day. So set yourself a time limit. Like, let's say either two ways you could do it. Like, hey, I'm going to trade from, let's say, 10 to 11 and maybe 1 to 2. And then, geez, I need to turn off my notifications. I'm like getting fully doxxed here. How do I turn on do not disturb? There we go. All right. Okay. So yeah, where was I? Geez, it completely threw me off guard. Yeah, so you want to set yourself time frames, either certain periods of times where you want to trade, or like let's just say a certain amount of hours, like let's say 2 hours or 4 hours in a day. Maybe you want to consider that because again, you have a life. Don't let yourself just sit there being exhausted looking at charts. Again, there's always another day. Let's see here. So the next thing is one of the most important subjects, which is averaging down versus doubling down. Before I get into this, just literally give me 1 second. I'm getting bombarded by text messages, so let me just respond to that. Just give me 1 second. All right, sorry about that. Okay, so averaging down versus doubling down. There's a huge difference between these two. And when it comes to this, so when it comes to anything in life, you should always try to relate it to past history. And when it comes to trading, obviously the history you can really look at is more, business, right? Because business somewhat correlates with the current, the way you trade and stuff like that. So averaging down is a powerful tool versus doubling down is usually a poison that's against your trading success. So I wrote over here Nokia has a similar story back in 2010, and it's an interesting one that relates to averaging down. Back in 2010, Nokia was falling behind because obviously Apple came along, Android was starting to grow. Both of these had their own ecosystems and superior apps and stuff like that. So Nokia was starting to, fall back in its market share. It literally dropped from 50% market share in 2007 all the way down to I think like 30% in 2010, which is a huge difference. Market share of mobile phones. So 2010 came along. Nokia's like, all right, let's get a new CEO. So they got an ex Microsoft CEO with around, I think his name was like Stefan Elop or something like that, and he joined Nokia. And one of the biggest things that led Nokia down this bad path is the fact that they were making mistakes in just, creating old technology and not looking to innovate and not, getting rid of the things that's causing wrong. And when Stefan came along, he just ended up doubling down on the stuff that was already bringing Nokia down to a low level. So instead of just trying to innovate and try to cut some losses, he instead doubled down and he started focusing on like making Microsoft phones. And as you guys probably know, Microsoft phones don't really exist anymore. And he started to see that Nokia lost even more ground to both iOS and Android. So because he doubled down on this, Nokia found itself in a deeper hole. Eventually this is funny, eventually he left Nokia, went back to Microsoft, and then Microsoft bought Nokia in 2014. So that's just ridiculous. And then anyway, moving on. So then after that, in 2014, Nokia needed a new CEO, and this guy named like Rajiv came along and became the CEO of Nokia. What he did was what traders should do when they're wrong. He cut the blow, he cut the losses that he had, he cut anything that caused the downfall of Nokia, even if it's been there for a long time. He cut it off, and instead he started focusing on smaller growth. And when he did that, he started focusing on Nokia's strengths, and Nokia started to build itself a little bit slower and gradually. Eventually, years came by, and I think like it was 2 years afterwards, around like 2016, and Nokia, after it finally built itself back a little bit, he was able to take a calculated risk, which is different than doubling down. He was able to take a calculated risk and become one of the leading manufacturers, or he became one of he took a risk on 5G and IoT networks or something like that. And because of that, now Nokia has become the global leader in telecom infrastructure. So what I'm trying to say here is, even though that's a weird story to look at, is the fact that one guy kept on doubling down on losses even though he knew he was wrong, versus another guy cut the losses, tried to grow back slowly, and then when he was able to take the risk, he took it, and he took a calculated risk. This is exactly what applies to averaging down versus doubling down. If you're in a losing trade, that doesn't mean you should be averaging down on it. That means you need to think to yourself, okay, is this a losing trade that I'm trying to just hope it goes right? Or is this a trade that's unfortunately going against me, but it's still valid? If it's still valid, okay, then averaging down again is going to be a powerful tool you can use if used right. But if this is a trade that's already going wrong and you just want to hope or risk the fact that it's going to not be wrong, that's just uncalculated risk. Take the calculated risk part. Know when to average down. Know if your trade plan is going according to what it's going to, or if it's not, right? So you really want to think, okay, am I averaging down or am I doubling down? If you ask yourself that question, a lot of times you'll take yourself away from averaging down in very bad areas, because as you guys probably have gone through, when you've averaged down in bad trades, you're in a lot more hurt than you were before. All right. Next point, trading unique to you. And we're kind of finishing up here on this presentation part. You could take a look at JP&I, for example. JP trades with stuff like moving indicators, MACD, versus I trade off of price and volume. He reads level 2, I just read candles. The way we perceive data is different. So trade you to the way you can perceive data, because when you do this, you're able to, trade with your strengths instead of with your strengths and with someone else's strengths that you don't necessarily have. And again, there's no shot against you, but just naturally some people do not have some capabilities others do. And some people just don't have some capabilities at all. So you need to figure out what works for you. And it's very easy to figure that out. You just have to learn and eventually find things that work for you. I have a story here, but I'm going to keep it very short. An example is eBay and Amazon. Obviously, when Amazon was growing, eBay started to fall behind. And instead of just looking at what makes eBay unique, they started trying to emulate what Amazon is. And because of that, small sellers on eBay started to fade away, which meant that people just stopped actually buying on eBay as much. And eBay found itself in a hole where it actually ended up with less sales than the previous years before, when it was not emulating or trying to recreate Amazon. When eBay went back to its roots and just, kind of fine-tuned its current uniqueness, and it just made its platform better while sticking true to what eBay is, eBay actually started flourishing, and then they ended up realizing that both Amazon and eBay, are both two complete different, they're two complete different online retailers. eBay is more for people trying to buy used or cheaper products, versus Amazon is for people who like paying a higher price tag for orders that are coming usually from warehouses or businesses and so on and so forth. So both of these are unique in their own way. And sometimes just because Amazon is beating eBay in sales does not always mean that Amazon is better than eBay. So figure out what's more unique to you. Now, my final thoughts on everything I said. Everything I said was pretty straightforward and simple. So what I will say is, if winning is a drug, losing is the withdrawal. You have to realize that everyone's always going to have a winning streak, and I'm really happy if you do. But I'm not trying to be a Debbie Downer when I say that that's not going to last long. And whether it's just one or two losses or a row of losses that's going to hit you, you have to realize you're going to get hit with a loss, and you should expect that. And when you get hit with the loss, the way you react to it is a way that defines you as a person who's going to be successful or not successful as a trader. You need to figure out, are you looking at losses as a penalty or as a teacher? If you're looking at it as a penalty, you're not going to flourish. And majority of people look at that just think of it like that, is just not going to flourish. You're not a baby. Majority of you guys are above the age of 20, if not 30. So looking at it as a lesson or as a teaching moment is going to help you possibly flourish, instead of looking at like, oh my God, why did that trade go so wrong? I can't believe this happened. I lost so much money. Quit crying about it. Even though I don't agree with a lot of things Trump is doing these past few weeks, one thing he said that was right is, you did that post on Truth Social or Twitter where he said, like, in a casino, you can't cry or something like that. And he's very right. Even though he's collapsing the economy in his own sort of way for a different type of perspective, you can't be crying that the market is going down, because you're the one who's partaking in the risk of trading it. So since you're risking and trading, you cannot cry. Every single trade you take, you are signing an agreement, theoretically or hypothetically, stating that you are okay with risking it. So get past the whining part and realize, okay, this is a teaching moment. Try to figure out what you did wrong, what you could do better. And this even applies to winning trades. Figure out what you did right. People only focus on the losers. Why? If you're a winner, you don't just look at what you did wrong. You always look at what you did right. Look at Formula One. You think those drivers, like for example Max Verstappen, I can't ever say his name. If he wins, you think he's looking at, oh, what did I, and his losses, you think he's just focusing on his losses? No, every single time he wins, he goes back, goes through the whole replay of his race and see what he does right and wrong. So when you have winning trades, look back at that trade. Think, okay, did I just get lucky or did I actually do something right? Whether it comes to the setup, whether it comes to sizing, whether it comes to the trade plan, a lot of these things you can look at and think, okay, did I do this right? If you don't take trading seriously, trading will seriously take you. Again, this ties to the first things I said in this session. This is like, you have to take this seriously. No one who's not taking it seriously has not been here as long lasting as I have. And this is not a gloat. I'm just telling you, if you were to look at anybody and ask, hey, how long have you been around? There's two people, and that would be JP and I. Because I've been on Discord for 9 years and I've been trading for 11. JP's been on for 4 years on Discord and he's been trading for 21. So the reason why we're here compared to all the people that we probably traded with in the beginning or saw traders, along the way, the reason why we're here and they're not, and possibly some of the people you're looking at now that won't be here 2 years from now, is because they don't take trading seriously. You need to take trading seriously in the highs and lows. You cannot take it less seriously when you're in the high, and you definitely can't take it less seriously when you're in the low. So always take trading seriously. You have to learn. You have to research. It is not just something you could go based off of luck. Even gambling, before I converted into Islam, I used to do sports gambling, right? Even that, where it's like you can't really control what's going to happen to the players, that itself, if you research, you still give yourself better probability. If you still put time into it, if you take it seriously, there's still better probability. It's much more greater, the probability, when it comes to trading, because there's a lot more factors you can control. So take it seriously, because if you don't, as cheesy as the saying is, it's completely true. So again, I'm sorry. I don't mean to be cheesy, but, it is what it is. If you don't look to learn, you'll always fall behind, and that's very true. If I've been trading for 11 years, and I'm going to keep on talking about my experience because I want to humble you if you're not humbled. If I've been trading for 11 years, until this day, I am still trying to learn things that I don't know, that means you should be doing that till the same time period that I'm trading at. I bet you guys don't even know about delta hedging. I bet you guys don't even know about gamma exposure. I bet you don't even know the definition of short squeeze. I bet you don't even know the difference between a short cover and a dead cat bounce. There's so many things you can learn, whether it's from our YouTube channel or reliable sources. Again, emphasis on reliable, because not everything on YouTube is reliable. So our live sessions is a thing, because a lot of these things are bullcrap. You need to look to learn every single day. One of the best ways you can learn is observing what's going on in the chart in front of you. I'm going to come out here and be completely honest with you. I have a huge ego. Not in a bad way, but in a way of where I like doing stuff by myself. When I first started trading, I had nobody to look up to. I had no mentor. I had nothing like that. All I had was Richard Wyckoff books and just a chart in front of me. And even back then, Wyckoff, I can never tell how to say it. I keep forgetting. But even then, his books are amazing. Because he's basically like you could call him the father of price action, right? Even then, his books were somewhere outdated. But I took his principles, and I looked at the chart, and I tried to apply that and understand that in ways I can learn. And because of that, I am here today, because I observe the charts. You know how easy it is to just pick up a chart like, let's say, Microsoft, go on the 2 hour, 1 hour, 30 minute, especially since I love the 30 minute. Just go back. Go back to a major breakdown. Go back to a major rally. Look at what happens before it. Did it bounce off of somewhere? Okay, draw a line at where it bounced off, right? A level, and figure out, okay, what made this level so important? Look at where the price came down and tested that level before. Oh, maybe that's what makes a level so important, because it fits this criteria, right? Or let's say something broke out of the trend line, right? What kind of trend line did it have to be for it to break out? What kind of pattern did there have to be for a rally or a breakdown? These are things you can do. If you put no time into it, even if you just come to live sessions where you get free education, that's not enough. I can sit here and I can give you a whole, book on how to trade, but that itself is not going to be enough. That's just going to give you a basics and just a core concept of what's going to be going on, but nothing will really stick with you unless you take the things you learn and you actually try to observe it on the charts. You can literally, in my experience, know nothing about patterns and candlesticks and go back on certain charts and actually take hours and look back at charts and look at breakdown and breakdowns on the bigger and smaller time frames, and you can actually learn about patterns without anybody telling you what they mean. You can learn what makes a fake out, what is an actual indication of an entry. There's so many things you can learn. That is how I learned. I'm telling you how I learned. I didn't buy a freaking course. Courses are dumb. You don't need to buy to pay. Courses are different than one-on-ones. I'll be completely honest. I do one-on-ones, but if you have the time to attend live session, you don't really need to try to reach out for me for paid one-on-ones. If you want to, that's completely up to you. But asking for someone's time is different than buying a course. Buying a course is completely stupid. Do not buy a course. I don't advocate for courses because courses are dumb. They don't teach you anything. And even if they do, you don't get... It's not like you're talking one-on-one usually with that person that you bought the course from. So you're not even getting any just unique perspective on anything. Everybody is different. So a course is not going to do crap. It's going to do nothing. You could get better value by not even spending anything but more than the trading view, premium subscription, and learn more than looking at the charts every single week, whether it's hours on a week or whatever. If you put time into it, I can tell you in my experience, there's a lot more benefits. And that just can't mean you look at charts and you only go according to that. No, you need to look at charts and you also need to learn other stuff to it. There's so many things you don't know. And there's so many things that you should know. Like, there's a lot of things like gamma squeezes, gamma exposure, delta, gamma, vega, theta, delta hedging, short covers, basically safe havens, right? Market rotation, which again on Monday JP is gonna go over the topic of market sectors and market rotation, which is one of the most important subjects you could ever learn, especially when it comes to swing trading and even day trading when it comes to a bear market. So make sure you tune in for that. But there's so many things you have to learn. But you can't just learn and you can't just observe. You have to do both at once. And if you do both at once, then you could always possibly find yourself in better situations than probably the person who doesn't. And the second to last thing I'll say is expect the unexpected, or you will find yourself gone within a year. What that means is that kind of ties into, whether you're in a trade or let's say you're doing really well in trading. Don't just be like, oh, my past results guarantees my future. No, I might have a 90% win rate every single year for the past, I think it's been like the 8 or 9 years of my trading out of 11 trading trading years. But just because I have the high win rate does not mean I will keep that same high win rate in a bearish market. For a person who is as consistent with me, I will have a rougher year. So imagine the people who are less consistent than me, who are going to be facing a bear market. You think they're going to be more consistent than I am? I've not found anybody as consistent as I am. So if I'm telling you that if I'm going to struggle with being consistent, not because I'm going to be bad at trading, but because my past results do not guarantee my future success, I'm telling you, you want to expect the unexpected. When you're on a series of wins, great, I'm happy for you, but expect the loss that you don't expect. If you get into a swing and it's a perfect setup, things just sometimes do not go your way. Example, the Palantir put that we took last week. How perfect was that short setup? There could not have been a more perfect short setup for Palantir to go down to $62. My entry was impeccable, but what happened? News came out. I think it had to do something with Ukraine. I don't remember the exact headline. And little did you know, our puts the next day unfortunately, they did go down for 15% profit. But what could have been a great massive trade just ended up being 15% profit, and then ending up me getting stopped out on the rest. So just because something looks great or just because something has been looking great does not mean it's going to continue that way. Be humble. No, be smart and be responsible. I don't sit here thinking, hey, I had an amazing week this past week between March, what was it, March 3rd and March 7th. So I'm going to go into next week and I'm going to have a 90% win rate. No. You think I sit here and think that? No. Each swing I take, I think, okay, if this doesn't work out, what am I going to do? I need to have that, because if I don't, then I'm just going to end up losing my money and your money. So again, expect the unexpected. And the last thing I'll say before I get to your questions and maybe what anything JP has to say is, no one is going to protect your success but you. Look, I'm here on live sessions and I'm teaching you things that I would usually charge people for on one-on-ones, or people would make you buy bullshit courses on. But in the end of the day, when I'm trading, I don't know what, I don't know how much success you've been having or the person next to you has been having. I don't know that. And I have to protect my success. And you can't quote me as evil for doing that, because you'll do the same thing in your situation. So no one's going to look out for you but you. And as corny as that sounds, what I mean is you need to do the stuff that's going to protect your assets, your portfolio, and you just need to stick to that. And if even if it ends up with you exiting out of a trade early, that's fine. You followed your rules, you followed your risk tolerance. If you keep on exiting early on a constant basis and you're following a certain set of rules, maybe you want to look at, if that's like impacting your trading growth, maybe you want to look at possibly altering or adjusting those rules to a way where it's still not risking too much while giving yourself optimal growth. So again, you need to look out for you. And if you're not going to, then you're just going to freaking find yourself, just in the back burners. And last thing I'll say before I hand it off to JP, if he has to say anything, is I started live. For those on Twitter, you guys should join live sessions. It's where I'm streaming this thing right now. It's a completely free educational server. But I started live sessions. Oh, what happened to my stream? I started live sessions 3 years ago. And it was because when I first started, I didn't have anybody teaching me. So I thought, I hope one day I could teach people, the lessons I learned, so that they don't need to go through as much pain as I did. Fast forward, I realized, okay, I have a platform here on Discord. After all, I am the most followed Discord trader on Discord. And I realized, okay, at least I could bring free educational content out there. But the thing that pushed me even more is the amount of misinformation there is out there and bad influences. A lot of the people that are putting out information, or a lot of people that are posting trades, are people who came after the pandemic or were only trading during the pandemic. They don't know everything. And a lot of the things they say is completely untrue and would not hold up for a longer time frame of trading. So that's why live sessions exist. It's because I don't like when stuff that should be, taught properly is not taught properly, and the wrong things are just displayed. It's just displayed. So again, I'm not going to call people out, I'm not going to call servers out, I'm not going to call courses out. You guys can figure out by yourselves. But one thing that I do have to say is, again, live sessions started 3 years ago, and it's been completely free the entire time. But I was in college 3 years ago, because I'm just 23, so I was in college, and eventually became my last few years, and obviously I had to concentrate more in college, and it became hard to research my own trading and also do live sessions as well. So live sessions unfortunately took a hit in activity. But fast forward, fortunately I was able to have my trading partner here, JP, who was able to step up and also help me with this workload. And now live sessions is back, and even back more than before, because now we're actually here streaming twice a week, both on Monday and Thursday most of the times. And these are topics, again, that people would usually either misinform you and charge you to pay, to learn. Even I'll be honest, even I charge people to do one-on-ones for me to learn the same things I'm talking about now. So take use of the free educational content, especially on our YouTube channel. If you don't follow JP and I on Twitter, you definitely should. But yeah, JP, is there anything you had to say regarding this topic?
No, I think you did some. Well, I do have a few things. I think you did a phenomenal job explaining risk management and the importance of recognizing your personality and your tolerance level. I also want to thank everyone that's on Twitter. We have over 300 people that are tuned into Twitter right now, watching this live session. And I just want to add this. I started trading when I was 20 years old. I'm going to be 42 April 1st. Yes, I'm an April Fool's baby. I have 22 years of experience underneath my belt. And for 16 years, I would consider myself to be one of the most profitable traders that I ever knew. It wasn't until after COVID 2021 and 2022 when things started to take a turn for me. And I had to readjust my trading style in the last 2 years, readapt what I was doing, and refocus. Um, it's important not only to understand risk management, but it's also very important to understand yourself as a trader, understand your personality, because trading will bring out the real person that you are. It will bring out all of the bad and all of the good. And if you're someone that suffers from depression, anxiety, someone that's hyperactive, someone that is overly aggressive, suffering from anger management, trading will bring that out on you. Trading will cause a lot of mental stress, a lot of physical stress, and a lot of I don't like to say I like to say the spiritual, because it also becomes a spiritual thing where you start to question God, right? Why me? Why me? Why me? So I always recommend that anyone who gets into this as a full-time job, similar to what I'm doing, and similar to what Kevin does, which is not easy, very difficult. Um, you need to treat this like a job. This is a paycheck to paycheck kind of thing, unless you're hitting home runs, which is very few and far in between. You come in and you work, you get paid, and you leave. You don't overextend your welcome, and you don't underextend it, if that's even a way to say it. If you treat this like a game, the game will beat you. If you treat this like a job and you learn and you adapt and you evolve with it, you can be very, very profitable. This is not something that is a get rich quick scheme. This is not something where you put in $1,000, 10,000, 20,000, and suddenly you're gonna walk away with $1 million. Slow and steady growth is the only way that you can have sustainability in this atmosphere. And Kevin said something which is very, very valid. And this is coming from one of the older guys in this space. And this is more towards the younger guys, because I could be most of your fathers. I could be the dad of most of you. Yeah, pretty much. Yeah. If I'm 42, if anybody who's under 21, yeah, theoretically, yes. Do not get um, do not get overly stimulated by what you see on the internet, especially on Instagram, Snapchat, TikTok, whatever, Twitter. Don't let those gains that you see from people that are posting from funding companies or from options trades be what triggers you to get into trading. Understand that what people post on the internet is only their wins. No one is posting their losses. The only person that I know that posts their wins and their losses and is very transparent with everything they do are my two business partners, and one of them is Kevin. So keep that in mind. And I'll end it with this. Live sessions on YouTube provides you with all the education that you need from two non-professionals and one guy who was me that was going to become a professional, because I went through the program to become an FA and I walked away from it. It was with Smith Barney and then Wells. You're not going to get anything better for free than what you're seeing on our YouTube channel. you should not be paying for the stuff that you have access to for free. And if you do a little bit of research, you're probably going to find most of the stuff that you're going to get charged for online that you can teach yourself. Please be aware of what's out there. And like Kevin said, the majority of the people that have been trading on this space have been trading in bull markets. They have no idea what a bear market is. They have absolutely no idea how to handle it. They have no concept of how the VIX moves. They have no idea what gamma is. They have no idea what call wall is. They have no idea what the buy side and the sell side is. And what they'll do is they'll mislead you. So keep that in mind. And hopefully, this risk management session that Kevin spent an hour and 40 minutes talking about serves as a reference guide for you, for everyone here, as to what you should be doing, what you shouldn't be doing. And I hope that you can walk away with this feeling that on a Saturday night you learned something and it wasn't a waste of time for you.
Yeah, pretty cool. Thank you again, JP. So we're gonna get into your questions that you guys asked. By the way, if you guys are on Twitter, I posted a reply to the live stream, which gives you the link to join the live sessions Discord server. And if you guys already aren't, definitely subscribe to our YouTube. It has all the recordings that we've had on live sessions on there as well. So let me get to the questions now. Whoops, that was the wrong page.
I have something to add
Yeah, what's up,
to one of your
Randy?
points, Kevin.
Yeah.
Hey, just because you had a winning trade doesn't mean it's a good trade. I'm just gonna put that out there. Like, again, adding to the luck factor. If you were in a short and ended up going your favor just because of a piece of news or something like that, does not mean and it was a winning trade. Not every winning trade is not every winning trade is always a good trade. There could always be something like poor execution or poor entry or any of that sort of nature. So just be cognizant of that.
Yeah, yeah, of course, because sometimes we could always get lucky on a trade and win on a trade that we possibly shouldn't have. Like, for example, if you get into a trade that was working against you and then out of nowhere news comes out and it just helps you push up, that's not really a great trade. That's just a lucky trade. So it's always good to figure out what were the right things you did, and if luck was on your side, then you got to think to yourself, okay, maybe I was lucky on that point. Maybe I should not try to recreate that. But all right, let's get into there's only a few questions, which is fine. It works out actually. So someone asked the difference in pros in between trading shares and trading options. Well, before I do any of those kind of questions, do you guys have any questions regarding risk management? Let's see. Okay. If I have a small account of 2,000, how much should I size in one trade? Can I put in 200 or a 10% stop loss? Sorry, I was eating a date. We can't answer that for you because we're not financial advisors. If I were hypothetically have an account with $2,000, I already told you the way I would go according to this. If I was okay with only risking 3% of my account, my stop loss would be $60 of whatever contract or trade. And then I keep on trading according to that. That's what I would do. But again, there's no concrete answer to that because everyone's situation is different. Everyone's the amount of risk they want to take is completely different, from person to person. I'll probably be much more of a risk taker because I can afford to be a risk taker more than you can be. So that is unfortunately something that you have to answer yourself. Again, we have the questions on there that you can figure out. There's actually under the resources tab, this took me quite a while to write out, so you should check this out. It's a series of it's just basically figuring out your risk management strategy. It tells you like questions you could ask yourself, and then like I will answer those questions in like for me. Uh, Read this, and maybe you can possibly get an idea of what you would want to be risking, because I can't unfortunately answer that for you.
Can I add to this? You know, a lot of the times we get asked the same question. I have a $2,000 account. Should I be risking 10%, this and that, blah, blah, blah. Once again, as Kevin said, we're not financial advisors. We can't tell you what to do with your money. However, if you're trading and you're putting on heat, you need to be prepared to lose that money. That's all I can tell you. If you're uncomfortable losing $100, then you shouldn't be risking $100. If you're uncomfortable losing 200, you shouldn't be putting 200. It's not about the percentage of money that you're putting at risk. It's how much are you willing to deal with losing. That's the caveat of this game, right? Like it sounds like, oh yeah, I made $200, I made a lot of money, but is losing $200 a lot of money to you? Or making $200 is not a lot of money. Oh, I could have made 1,000. But if $200 hurts you that much, then you need to size a lot smaller, like a lot smaller. You know? Oh, but trading one contract doesn't make any sense. Why doesn't it make any sense to trade one contract? Oh, because I can't trim. How many people do you know that have grown small accounts just trading one contract? I'm doing right now currently a small account challenge with $500. I've taken that account from $500 to $728 in less than 10 days. And that's me trading one or two contracts max, and that's not day trades, that's only swing trades. I have another account where I'm swinging a lot bigger positions. But you can easily double an account as long as you're taking the right trade, right? And if you have the proper risk management. So if you're putting on heat, you got to be prepared to deal with the consequences of it. You know, that's the beauty of this game. So when you say, "Oh, how much should I be losing?" It's whatever you feel individually comfortable with. If $20 hurts you, then $20 hurts you. If $200 hurts you, $200 hurts you. It's whatever you can personally risk. And you also should not be trading with money that you desperately need. You shouldn't. It makes no sense. It'll drive you nuts. You're talking to a guy that went from having an account from $500,000 to 100,000 to then 50,000 to 10,000 to now trading on an account under 5,000 because I've taken a lot of money out because I don't want to trade in this environment with a big port. Because I get tempted to want to put on more heat. I don't want to do that. So what do? I limit the amount of money that's available in my trading account because I know what I'm capable of doing when I start to see things. And I don't want to put myself in those situations. So I reduce my port and limit the amount of trades that I take to only the things that I can fully execute that I truly believe in. And that's what I'm willing to risk.
Pretty well said. Someone said something over here that I want to actually reiterate. So I was talking about the market fill and limit order. On some platforms, there's such as Thinkorswim. You're also gonna have the option of like limiting the ask or the bid. I personally don't ever do that. I always just try to limit the midpoint. So if the spread is, let's say, 95 and $1.05, the bid is 95 cents and the ask is $1.05. I'm trying to bid at $1. So if you bid at the ask, you might as well just market order it as well. But yeah, so you don't maybe like I personally don't ever find a reason to do ask, limiting the ask, because we're not freaking institutions, you know what I mean? And if I ever find myself just missing out on the trade, then it's fine. You know, I missed out on the trade. Big whoop. All right. Like no one can tell me that I actually missed out. I'll be telling you, okay, well, you missed out on 11 years that I had of successful trading. So, you know, right back at you. So,
I just want to put an example of risk management because I got to get out of here soon.
yeah.
You know, I was texting Kevin in between the recording, and I was telling him, tell them about Lambridge. Tell them about Lambridge. I took a position on Lambridge into earnings. It's a company that I truly do believe in. And I knew what I was getting myself into. And I had told Kevin, I know what this company is going to do. I know what they're about. And I know how this trade is going to pan out. Long story short, when Lambridge reported earnings, it was a street miss. What do I mean by that? that the consensus estimate was not what they were expecting. However, it was an internal beat. What do you mean by an internal beat? The company was doing better numbers than they were the previous quarter. So the street had overestimated what they thought they were going to do. So therefore, it was a down trade. And that was on March 6th. The next day, March 7th, the stock goes up 10%. If I would have held on to that trade, I'm sorry, the earnings came out on Wednesday, March 5th. March 6th, it was down almost 10% or whatever it was, 7%. The next day it was up 10%. If I would have put a stop loss on this trade when it was down, I think at one point 50%, and it was down 50% because of the spread, I would be killing myself right now because I knew that there were institutional size orders at $58. And now we're back inside of this falling wedge on the 100 on the daily. It's a giant falling wedge, and it looks like it's going to break above 73. But I stayed in this trade knowing damn well that I had 2 months for this to fully execute itself. I knew what my trade was going to do. So when you talk about, oh, I should close my position because it's down 50%, well, if it gets invalidated, then yeah, but if it's still valid, why would you get out? I would have gotten out of my trade if it would have broken below $58. It never did. So this is a perfect example of how my risk tolerance was on my side, even though I was down a substantial amount of money, because I knew what the execution of my trade was going to be. If it broke and closed below a certain level, I would take the loss. But if it held, I knew that it was going to retrace back to the upside into the mid 70s. And now I'm on the right side of this trade, and they were currently up 17% on these contracts. So I went from being down 50% to up 17.
Yeah, daily on Lambridge looks great too.
Incredible.
Sorry, I'm eating dates again. All right, JP, before you go, this question was for you. It was pretty nice. It asks, can you please take an example of a 10K account and how do you manage the risk and position sizing?
If I'm trading options at any given point on an account that's 10K, I don't like taking more than a $500 position on it. And I don't take $500 positions unless those are incredibly well positioned swings that I believe in. I don't like taking contracts that are worth more than $1 or $1.25. My sweet spot is normally in the 70 to 80 cents. And when it comes to managing a $10,000 account, if I'm taking a trade and I have $500 on the line and I'm up 20, 30, 40%, or even 50% on $500, $200-300 on a $500 position, I'm closing my position. I do not leave runners because my end game is to grow the account. It's not to hit home runs. So for me, if I have a $10,000 account, I'm not taking any 0 DTEs. I'm not trading spies. I'm not trading Qs. And I'm being very particular about the swings that I'm taking and making sure that my downside on the swings is not going to destroy my account. I personally do not like being in a swing that's 2 weeks out, that's down 50% the next day, or 3 days out, right? Because not only do you have time against you, which is theta, but if it's down 50%, that means the price went completely against you. So you at that point have to manage the position. I also don't believe in averaging down contracts. I believe that if you are in a trade, in a swing trade, and you are on the wrong side of the trade, sometimes it's better to exit for a small loss and re-enter at a better position than it is to average down. Because if you're averaging down on a $10,000 account and you put $500 in, that means you're going to have to put double the amount to get the best fill. So that means now you're going to have to risk $1,000 to bring those contracts down to a really, really good price for you to see the risk reward, which means that you're putting in now $1,500 of risk. It's not worth it for me. So I never want to be in any position on a 10K on my 10K account. I never want to be in any position that's more than $500. Punto y basta.
Good answer. As I ate a sour date. Wow, that tasted bad. One thing you guys can also look at on our YouTube channel is when we talked about, ties into what Randy just posted. Debit spreads are a great way, in my opinion, to grow small accounts. Credit spreads are pretty good as well. Usually you need a little bit bigger account, or if you're a novice trader, you have to learn how credit spreads work. But credit spreads and debit spreads are really great ways to grow small accounts. Where is that video? I can't find that video, but yeah, here it is. So the debit spreads, if you don't know how to use debit spreads, an amazing way to grow a small account. You do need margin on it, but for example, I've been personally doing a small account challenge. I started at 400. It reached 900 last week, and I was only exclusively doing debit spreads. So if you don't know what debit spreads are, watch this video. Watch credit spreads. If you have more capital, this is something you could do. And if you remember the bearish video, I did talk about how credit spreads are going to be safer trades and safer alternatives compared to naked option trades, which are usually what you guys do, which is buying calls and puts. So definitely feel free to check that out. Let's see. No, the YouTube channel, I'm gonna put the link right here. I'm gonna put it in the main chat. You can check the main chat. Again, this is the name of the YouTube channel. Again, I put the link in the chats. I appreciate that, man. Ramadan Mubarak to you, to whoever's Muslim here. Do you have a video at the plot levels and use Fibonacci? Absolutely, bro. Of course we do. We have both those videos. So we have one on pivot points. We have one on fib retracements. And we also have one on fib extensions. I said also like 5 times, but additional to that, I have a video on levels here, how I draw and trade levels. But all these topics I'll still go over again in a future live session. So, yeah. But you could still watch these. This, like, for instance, this level video is just 16 minutes long. I could probably go when we do a future live session on it. You'll see both how JP and I both draw levels because they're actually different, and the way each of us draw levels could be beneficial for some people versus the other, right? So it will be pretty nice. Be kind of cool when we do that. Would you rather buy 1 in the money contract or 3 out of the money contracts while risking the same amount? You already know what my answer is. It's going to be that 1 in the money contract. I will absolutely do that. When it comes to day trading, I'll tell you this. When it comes to day trading, especially for a nice option chain such as Microsoft right now, because everything has high IV percentiles, current IV percentiles. Microsoft is a little bit better compared to them. Microsoft, I trade at the money or I don't trade in the money, but I trade at the money contracts, and they're expensive. But man, are they just such a stress-free freaking option that you could trade. Anything that's at the money obviously doesn't mean there's no risk, but it does mean it's risk, but it's a little bit less than that. So, for example, if I just pull up I just want to draw this out because I like drawing. I feel like it explains better. Where the heck is it? Oh, give me a second. Let me pull it up again. Let's see. Give me a second while I pull it up. Okay. So, for example, if Microsoft is at, let's say, $398, and I buy a 400 call, obviously this is at the money, right? In the money would be 398 or 397. But I could buy 400 or 399s, but I'm pretty sure the way Microsoft's option chain is it jumps every $2.50. So the contracts on the option chain would be like it would be, oh my gosh, it will be the 400 strike the I think it'll be like the 397.50, and then above will be like the 402.50, and then let me move this down. And then on all the way up here, you might see, like, for example, the 405s or the 407.50s. These two are considered out of the money. And hey, they can be great. That's fine. For example, if you're trading the next week expiration, okay, there's less risk going for out of the money contracts because, again, you have a little bit more time on your side. But if the price right now is at, let's say, 390, what did I say earlier? 398, right? Obviously, this is going to be at the money. This is also going to be considered close to being at the money, and these are out of the money. This is in the money. I personally won't. I won't go for this kind of contract. I can if I really am hesitant, but if I'm hesitant about a trade, I don't find the reason why I should be entering into it. So I'll enter into this either the 400 or the 402.50s. If I take this 400 call, for example, and these are calls, right? This is a call. We'll just say this is calls. If the price, let's say I buy right over here. If the price goes like this, let's say I'm up, but then it just goes down, or whatever, it just rejects a level. If it comes down here, and this might be, for example, like the 50 fib ratio or the 61, the out of the money contract for the same week will lose around approximately 30 to 40%, versus the in the money or at the money contract, let's say, for example, the $400 contract, will only lose 15% or less. Yeah, not less, actually, around 15% or just a little bit more. So definitely below 20, but usually not less than, not more than like 20%. That is the power of it. So yeah, of course, 20% of whatever this expensive con is, whether it's $3 and this is, let's say, 275, and let's say these are 175 and this is 125. Yeah, of course, 20% of this is going to be a lot, but imagine sizing into more cons and losing 30% on this. If you buy 3 cons of this, 1.25 times 3 is $3.75. So in total, let's say this contract actually over here, to make it equal price, is $3.75. 30% of that, I can't really do the math. 30% of that is going to be smaller than 20% of this. So do you see how the math kind of doesn't make sense to go with usually the out of the money contracts? Because if you're putting in the same amount, you're losing the value much quicker if you're holding the trade. And let's say you have a stop loss at 20%. Okay, you get 25%. Let's say you get stopped out of the money contract. You're out by 25%. But the at the money contract, if you still had it, let's say it comes here to a fib level and then bounces after that, right? And it's still in your trading plan, you don't get stopped out on that trade. And theoretically, at that point, you're risking less money because it didn't hit your stop loss. This was your trading plan. You saw that this was a fib level. It held it and it bounced up. So hopefully that answered your question in, I keep on switching over. Hopefully that answered your question. Oh my goodness. What? All right, let me, yeah. All right, let me go to the next question. I don't know why this is bugging out on me right now. Okay. Let's see. Hopefully I answer your question. What'd you say?
Any other questions?
JP, your mic's
I got
on.
a question here. Someone
Oh.
asked. Let me answer that one.
Yeah.
Are swings worth taking right now if you see a good setup with everyone going on right? Are swings worth taking right now if you see a good setup with everything going on right now? I'm assuming that's what you mean.
Yeah.
It is, in my opinion, it is, as long as you're in the right sector. Um, one of the most important things to understand is what is your market and what market you're in and where the money's moving. So if the money is moving into a certain part of the market and you see something that has the potential to continue to pop, of course you should take the swing. For example, Kevin and I have rotated out of high beta, which in this case is technology, into what we call the boring stuff. What's boring stuff? Pfizer. What's boring? Colgate. What's boring? General Mills. What's boring? Coca-Cola. Give me another boring stock.
J&J.
Johnson and Johnson. Give me another boring one. Give me one more boring
Merck. MRK.
one. MRK, right? Boring stuff. Boring stuff is moving right now because it becomes a safety net. You know, Waste Management, Procter and Gamble, Hershey's, Honeywell's,
Pepsi.
McDonald's, Mondelez, all this stuff. It's boring. It's stuff that people don't actively trade. But guess what? It pays a high dividend. So because people want to be invested in the market, because you never want to be, you theoretically, unless you're Warren Buffett, you never want to be all cash. You want to reinvest your money. So guess what? If you start seeing a rotation into safety, like in this case, for example, Clorox, I'm going to use, guess what? There's going to be a great setup on Clorox at one point that you can take and you can sit on it because you know that the money's going to be piling into it, right? Or Procter and Gamble for that matter. We were talking about Procter and Gamble back on February 24th. It had a phenomenal setup, and Procter and Gamble popped from 170 all the way to 180. We weren't on that. We weren't in. I didn't get into that trade, but there's a lot of people that I know that were in it. So yeah, there are swing setups that you can take as long as you're in the right sector that will work out for you. Now, if you're trading and you're taking a position in a highly volatile market on something like Tesla or AMD or Nvidia, or I would even throw Hood into that equation, then you're putting a lot more risk on the fact that that trade could go against you because it's such a high beta driven stock. So as long as you're on the right sector, you'll do fine.
Majority of the times, it's not financial advice.
Yeah.
And regardless of if you think a sector is going to go up, you would always want to make sure you're in the right, you have a setup going along with it,
Of
right?
course.
Yeah, absolutely. I just want to, I know you know that. I just had to clarify for people who don't. Yeah. Um, and of course, Ramadan Kareem to you. Um, do you guys have any other questions regarding anything related to risk management? You could literally ask us anything and we'll try answering it if we can to our best ability. How do I
What do
see?
women really want?
What?
What do women really want?
Not you.
Wow. Wow. Wow.
Whoops. Um,
I
how
only
do
see one more. I only see one person typing, so I'm gonna go ahead and take the initiative of this, um, and say that if there's no more questions after Jebsco finish typing, how about AG future slash ETFs? Perhaps they will also bounce given the geopolitical outcomes near future. What? I don't understand the question.
what are you talking about AG? What do you mean by AG futures? If you're talking about ETFs such as SPY, QQQ,
No,
VOO.
he's talking about agriculture.
Oh, sorry, I'm dumb.
Yeah.
Um, I don't have an opinion on agriculture futures. I haven't done much research on it, so I can't unfortunately say anything there.
I mean,
Um,
if you're trading,
yeah.
if you're in here and you're trading, if you're in here and you're trading corn, soybean, lean pork, lean beef, and those kind of futures, then my friend, God bless you on that. Uh, it, I know a couple of wheat future traders, and I've never seen people that look worse than those kind of guys because it's another level of degeneracy that I would never get into. I have traded soybean futures on my personal account in the day, and let me tell you something, fucking terrifying. So yeah, I mean, I don't know if you know if I there's one particular stock that I trade whenever it's regarding agricultural trades. It's I believe the ticker symbol is SMG. It's Scotch. What is it? SGM. I'm drawing a blank here. It's the people for the grass feed. What is it called? Um. Oh, this is gonna bother me. Scott's, yes, but what's the ticker symbol on it? This is gonna SMG. There it is, SMG. Scott's Miracle Grow. That's the only thing that I trade when it comes to the agricultural sector because it's all the it's for it's the fertilizer stuff and all that good stuff. So yeah, for hydroponic gardening, whatever it is. Kevin, are you here?
Yeah, I'm here.
Yeah. By the way, there's a great setup right now on SMG. I'm sorry. Sorry.
By the way, talking about safe havens earlier, I have a watch list of like a starter group of safe havens that you could possibly consider. Some of them consist of stocks such as Waste Management, KMB, GIS, PG, Coca-Cola, Pepsi, storage units such as PSA, EXR, Cube, NSA, Colgate, MDLZ, NEE, KHC, Johnson Johnson, MRK, BTI, Baba, KWeb, Baidu, Billy, P Diddy stock, and Clorox. I did post that watch list link in the main chat, so you can refer to it. It's not a complete list, but it's just some of the safe havens you could possibly look at. And this actually ties to something we talked about in the bearish market video. If you like trading bull setups similar to me, sometimes what you can wait for is a bull setup on safe havens because those have a higher probability of running compared to something such as a high beta stock such as Nvidia, Tesla, or Meta. Because, yeah. So, in your opinion, get out of trading on Robinhood if I want to get more serious. I can't give you a. Oh wait, I can give you my opinion. Um, if you want to find yourself not hating, getting bad fills, then I would get out of Robinhood personally. Because I have seen more people lose money on that than you would want to know. And again, if you're not like day trading and you're just doing longer term swings, dividends, leaps, long-term portfolios, then Robinhood theoretically matches all the things you need. But if you're day trading, it's going to be a little bit harder to get the fills that you want on Robinhood. Especially like, a lot of times you're not for your whole trading career, you're not just going to be trading SPY QQQ, right? We've talked about diversification and your diversification of the tickers you look at. You need to have good fills. And I've always said we're not sponsored by Thinkorswim. I'm not sponsored by Thinkorswim. I was looking today, to be honest with you. I'm like, there's got to be an affiliate link that I could give out for Thinkorswim, but I think there's none. So I gain nothing by saying this when I say that Thinkorswim is the most superior trading platform you can have. You can literally ditch TradingView for Thinkorswim. So it has a huge amount of tools, it has amazing, phenomenal fill times. It's something that you guys should look at. I don't have a video on Thinkorswim just as yet, but I can look to do it. And what I did say in the past multiple times that one of the most powerful features on Thinkorswim that no other trading platform has is the feature to go back in time. It's called on demand. And yes, TradingView does that, but the thing it doesn't do is it doesn't bring up the option chain for whatever stock you want in that current time. Thinkorswim does that. So you can literally go back to last year, July, and look at, let's say, Apple's stock, and you can actually see, you can see the current movement, not current movement, or the movement of options and the actual price of options back then at that specific minute. And you can enter fake positions to see if your strategy would work back in that time, which then would mean, hey, maybe it would work now, right? So Thinkorswim's great, and all you need to put is like $50 into account or $100 into account to just have live data on it, which you don't, it's not like a subscription. You can withdraw that anytime you don't want to use it again. So, yeah. As I learn and hear you guys share more knowledge, I can see many times where it feels right. Yeah, unfortunately. What about IB compare? If you're talking about interactive brokers, I've not heard many bad things to them about them. I have not personally used it as much, but I've heard good things. I just feel like it's a more simplified trading platform that's also available for people in different countries. So in that standard, if it fills your criteria, if it's giving you good fill times, that's fine, right? You don't need to necessarily switch out. If you want the best fill times, if you want more tools, that's when you switch to Thinkorswim. Yeah. Tasty Trades, thank you. Yes, Tasty Trades is also good because the co-founder of Thinkorswim, Tony Sazonov, left Thinkorswim and went to create his own trading platform called Tasty Trades. Has amazing fill times and is really great for swing trading and people who trade like spreads. So definitely another thing, platform you could check. And if you're facing like really high commissions on trading platforms and you trade a lot of contracts, Tasty Trades is actually pretty good because I believe there's a rule where you can cap your commissions at just $10. That's very important for a trader like me because I trade spreads, for example, and spreads require more than one option leg. So I therefore would be paying a lot in commissions, even though I have the cheapest rate for TOS. So that's why, for example, Tasty Trades would come out ahead in that department. So you could see how each trading platform has its own pros and cons.
Kevin, I'm here. Sorry, I didn't mean to cut you off. I didn't go anywhere yet.
Oh, okay, cool. But any other last questions, or should we wrap this up? I'll let you guys type. I'll give you guys a minute, and then
I want to thank again everyone that's on Twitter. We have over 400 and almost 5.
Oh,
A little less, maybe it's a little more. I don't know. But last time I checked, we were like at 472. So thank you guys for tuning in on Twitter. We're gonna try to do this more often. Also on that Twitter live space. So if you aren't following us, please follow Kevin and myself. It helps us with our reach and yeah, hopefully you guys are enjoying this on a Saturday night.
Yeah, we wouldn't have held on Saturday night if the recording went fine on Thursday, but yep. All right. Well, there doesn't. What was I gonna say? Well,
I got something to say.
What's up?
I got something to say before we go.
Yeah.
I appreciate everyone that's here again on a Saturday night because it shows how serious you're taking this. And I don't mean to sound like a complete asshole here, but Kevin and I have a lot of other things that we can be doing on a Saturday night other than this. But this shows you how dedicated we are to this art form, because it is an art form, in my opinion, and to this craft, that we spend the time to do this. And please, guys, take this serious. This is not a game. We don't want to see anybody get hurt. We don't want to see anybody lose money. We don't want to hear the nightmare stories. And I don't want anybody to go through what I've gone through, which is, losing substantial amounts of money because of my erratic behavior and my lack of discipline, that I've had to get to a point where I reprogram myself to no longer be that person. So learn from the mistakes of others and don't be that guy, please. Just don't, or girl, or in between, whatever you are.
And
just don't be that person.
And you wouldn't want people, dealing with the meteor that you had to deal with, right?
Pretty much.
Back in the dinosaur ages, since that's where you're from.
Pretty much.
Yeah. All right. All right, guys. Thank you again for joining on. Again, pleasure talking to you, JP. Thank you for coming on here as well.
I'll talk to you mañana, of
Yeah.
course, and then I will see you Monday for something that I think everyone should be tuning in for. I think everyone should be here on Monday for sector rotations and how they work. Outside of risk management, I think this is probably the second most important subject matter that we're going to be covering, to be quite frank.
Yeah, that's pretty true. All right. I'll see you guys Monday.
All right. See you later, guys. Have a good night. Have a safe Saturday if you're going out, and have a shot of tequila on me. Bye.
See you. Peace.